So welcome to the second learning objective for chapter 11. Here you're going to be introduced to variances, okay? And a variance is basically the difference between the actual cost and the standard cost, all right? And here we're looking at total actual costs compared with total standard cost. So in general, if your actual cost is less than your standard cost, you're set to have a favorable variance, okay? But if your actual costs are greater than the standard costs, then your variance is considered unfavorable, okay? And again, this must be, all variances are analyzed with the idea of what was the factor that caused it to be favorable or unfavorable. Okay. Of course, they look a lot at the unfavorable variances in detail, although you can learn from both. You can certainly learn from both. So analyzing variances really begins by determining the cost that comprise of it. So we're going to be looking at a lot of those. Okay. So a variance is favorable if the actual cost is less than the standard cost. And we're looking at totals for this. All right. So here's the fun. Page 471 begins with an illustration, and it kind of shows you how all these types of things are done. Okay. So here's the assumption. We're going back to our gallons of Zonic tonic. I really don't like Zonic tonic. But they have produced 1,000 gallons of Zonic tonic in June. And Zonic has incurred rather these costs, right? Direct materials, 13,020, direct labor, 3,108. Variable overhead and fixed overhead are listed here. Total actual costs were 55,000. Okay, and that's in your book, illustration 11.8 on that page 471. However, the standard costs were calculated at $52,000. Okay, so in this case, our actual costs were 55,000. Our standard costs were 52,000. The total variance was $3,000. Okay. So let's take a deeper look. One thing we need to look at is we're going to be looking at variances in all these areas. So first, we're going to look at the direct materials variance. What changed? What was different with direct materials? And as you see, we're going to look at the actual quantity, AQ, and the actual price, AP, and compare it with what we calculated as the standard quantity, SQ, times the standard price, SP. That's going to give us our variance, TMV, total materials variance. Okay. So for this 1,000 gallons of Zonic tonic, they used 4,200 pounds of direct materials. They were purchased at a cost of $310 per unit. However, the standard price, as you see, was $3. So clearly the actual is different from the standard. So that's what we have to calculate. Well, if you looked at what we actually did, 4,200 pounds at $3.10 per pound, we spent 13,020 bucks actually. Okay. We were expecting to only use 4,000 pounds at $3 per pound. In other words, we were only expecting to use $12,000 of direct materials. So clearly the difference is unfavorable because your actual is much greater than your standard by 1,020 bucks. Unfavorable because your actual is higher. So this is step number one. This is important to do. You're going to have to do this. Another thing to look at is the company analyzes the total variance to determine the amount attributable to both the price and to the quantity. Okay, so remember we had a standard quantity of 4,000, but we actually used 4,200 pounds. So what if we replace the standard quantity with the actual quantity? Can we come up with the material price difference? Well, as you know, we used 4,200 pounds and at $3.10 a pound. But if we then subtract out the 4,200 pounds at the expected standard price of $3, that would account for $420 of our variance. Okay, so again, your actual is still higher than the standard, even with the updated quantity, by $420. This is also important, and this is on 470. Okay, just is it 470? No, it's on 469. Sorry, 460. No, I'm totally wrong. It's on 473. I'm sorry, I'm gonna have to re-record this one. All right, I don't know what page I'm looking at, but that's the page. Okay. So of that variance, as you see, the price made up a $420 unfavorable. But what about the quantity? Remember, we were only expecting to use a certain amount. We actually used more. All right. So if you look at the actual quantity and compare it with what we were expecting, the standard quantity, you're going to come up with the difference. So we actually used 4,200 pounds, right, which made it $12,600 cost if we stuck with the standard price. We were only expecting to use 4,000 at 3. So this accounts for the additional 600 difference, which is the quantity variance. So again, they're breaking it down into looking at the difference, right? The variance for price and also the variance for quantity. When you look at the variance for price, we came up with the $420 unfavorable. If you look at the quantity, you can see here was $600. So the total, as we looked at in the very first slide, for $1,020 difference, right? Unfavorable. So it's broken down into price and into quantity. So that's what's a little different here. This is just a matrix looking at the bigger picture. If I am not mistaken, this is on page 474. Don't want to look like an idiot twice. So what it looks like here is a big overview of all the things we just did. Okay. So the very first thing we did here, number one, was calculate looking at the actual quantity times the actual price, right? AQ times AP. The second thing we did was look at the actual quantity, but at the standard price, what we were expecting to pay. And then we looked at the standard quantity at the standard price, which is what we were expecting here. So as you see here, these three steps were put together. The price variance looks at the difference between, in this case, block 1 and block 2. Okay. The $13,020, which is the actual quantity times the actual price, subtracted that out from the actual quantity times the standard price, right? What we were expecting with the standard price. That creates a price variance. The quantity variance comes in by looking at the actual quantity at the standard price, which is the 12,600, box 2, subtracting out what we had expected, standard quantity at standard price. That gives us the other $600, right, in difference. And in terms of the total, well, you saw this early on. The total was $1,020 unfavorable. But to break that down, that 1,020 is broken into the quantity variance and the price variance. So there are a number of reasons why these things, why the materials variance happened. Okay. There are factors that might affect the price, including what the availability was of the materials. Did we get any cash discounts or not to get those? What was the quality of the material? Sometimes if you don't have as good a quality material, you might need to use more of it to produce what you had. And what type of delivery method was used, and of course the costs involved with that. So this might help next time when they consider setting the price standard. The purchasing department needs to make sure they're looking at all these types of things more carefully to get a more accurate price, or at least to account for the variance. What about the quantity? Well, sometimes you might have machinery that's not working all that well, and thus it's not using the quantity very well. You might have a number of inexperienced workers that might go through quantity a little bit too much. There might be waste, carelessness that's involved. And so that production department is going to have to look at what exactly caused the quantity to be off so much. And of course, it was unfavorable. All right, so now it's going to be your turn to do this, okay, in terms of looking at the differences, the variances for direct materials. This is on page 475, and I'm pretty damn sure about that because I just checked. So if you look at page 475, you will see this exact one. So again, the standard cost of Wonder Walkers is 2 units of direct material at $8. During July, the company buys 22,000 units of direct material at $7.50. And they use those materials to produce 10,000 units. Okay. So compute the total, the price, and the quantity variance for material. So first of all, let's look at the standard quantity. Right? So the standard quantity is, in this case, 2 units times what they plan to produce, which is 10,000. So that's the standard, 2 per unit, and they want to produce 10,000 units. So that's the standard. So now we start looking at some differences. When you start substituting the amounts into the formulas that we just looked at in the previous chart, let's take a look at what those variances are. So first, the total materials, and then we'll look at the material price and material quantity separate. So in terms of the total materials, as you see, you had 22,000 units at $7.50. This was the actual, yes. And of course, you are going to take away the original 20,000 units, which was the standard quantity that was expected at the standard cost, $8. And at this point, your difference would have been a $5,000 unfavorable. Okay. All right, so that's the total. So clearly the price and the quantity variances will come back to equal this total. Let's take a look at simply the materials price. So in this case, we have 22,000 units, this is the actual, times the 750, which is the actual. And we're going to subtract out the 22,000 units, which is actual, times the $8, which is the standard cost. Okay. And when we do that, we'll see that we actually had $11,000 favorable. Okay. Say 50 cents per unit. However, when you look at the quantity is the 22,000 actual times the unit standard minus what we had thought. 20,000 was the actual standard times the 8. So you produce 22,000 instead of 20 at a standard cost. So that's going to make your quantity change. In this case, by 16,000 unfavorable. So 16,000 unfavorable, 11,000 favorable, that difference is 5,000 unfavorable. So it's those two numbers together. And that is learning objective 2 in a nutshell. Other than not getting my pages right, I think I got that one right. So you see how you're going to have to follow that pattern that's been provided for you, yes? Right. Comparing standards with actual. And the formulas are very important in this part of the chapter. Questions?